Now we'll finally talk about the discounted cash flow model. Mathematical model. The discounted cash flow is a financial model used by investors to determine whether it is worth it to buy a business and how much you should pay for it. This is used by a huge amount of people to see if you should buy or not a stock. Imagine you're paying money now in expectation of receiving more in the future. We can say the discounted cash flow analysis rests on the principle that an investment now is worth an amount equal to the sum of all future cash flows it will produce, with each of those cash flows being discounted to their present value. We'll find out more about this later. This is the formula. Just remember this is very important. Even if you don't understand the concept and you want to use it, remember the formula. The discount rate is the rate of return you want for your investment. So we can make an example here. Let's say you own this shop. The shop has a cash flow that goes up 5% every year. The discount rate is 8%. So we're gonna use the formula right now. Let's say for year 1, 2, 3, 4 and 5. For year 1, the free cash flow is 100k. You can find that on the annual report. Let's say it goes up 5% every year, and as you can see there is this kind of compounding effect. So the free cash flow for year 5 is 121.5k. The discounted cash flow using the formula goes lower, of course, because you need to increase the value of the n in the formula. Not over though, because you need also to calculate the terminal value, which is the final projected cash flow times 1 plus perpetual growth rate divided by the discount rate minus the perpetual growth rate. In this case, we use the discounted cash flow of year 5 and the perpetual growth rate of 3%. The perpetual growth rate refers to, let's say, an infinite series of identical cash flows. The perpetual growth rate is typical between the historical inflation rate of 2-3% and the historical GDP growth rate of 4-5%. You don't want to use a number bigger than that because you are assuming that the company will outpace the economic growth forever. The present value of the terminal value, which is basically the discounted cash flow in this case, is 178k. We are using the same formula right here. Now the cool part starts, because we're gonna find out the fair price. The net present value is calculated using the discounted cash flow and subtracting the cost of investment. So next we are gonna calculate the sum of the present value of the free cash flows. We found between year 1 and year 5 it is 437k. The enterprise value, in this case we are gonna add the present value of the terminal value, and we have a number above 600k. The net debt, we're gonna assume it is 50k, so we are subtracting the cost of investment. We can also subtract minority interest, add cash and bank deposit and other stuff. The intrinsic value of the stock is 565k. So let's say the stock has 1000 shares outstanding. We find that the equity value per share, or the fair price, is $565, for example. So the net present value is very sensitive to the discount rate. Small change can cause a large change in the net present value. Remember, if the stock has a higher price than 565, you can see there can be an opportunity in that stock and you may buy that. Of course, there are other valuation methods. Warren Buffett uses the owner earnings. There are different types of discounted cash flow. So this is a very delicate topic, not easy at all. You need to find the one that suits you better, I think. I try to explain it as easy as possible.